Welcome back to Currency Hacks, where we don't just follow the markets, we decode them. If you're new here, hit that subscribe button right now because what I'm about to show you isn't something you'll hear from your financial advisor or see on CNBC. This channel exists for one reason: to give you the institutional level insights that actually move markets while everyone else is distracted by headlines. Let's get into it. On January 15th, 2025, something happened that most people completely missed. While you were watching silver drop to $29 per ounce, China quietly implemented export restrictions on antimony and other critical metals. Now here's what they're not telling you. Silver uses the same supply chains, the same refineries, the same logistics networks. And in exactly 72 hours from when those restrictions hit, COMEX, the exchange that sets the price you see on your screen, faces a delivery problem they can't solve with paper contracts. The question isn't whether this creates a crisis. The question is whether you understand what happens when the paper price says $29, while physical dealers can't keep metal on the shelves. Stick around, because what I'm about to show you doesn't insult your intelligence, and it definitely isn't what the mainstream financial media wants you to know. Let's start with something that doesn't make sense. Silver dropped from $34 to $29 in a matter of weeks. That's a 15% crash. Your broker, your financial advisor, maybe even the charts are telling you this is bearish. Metal is getting cheaper, supply must be abundant, demand must be falling. But here's the problem with that narrative. While silver crashed 15% on the COMEX exchange, physical premiums at bullion dealers exploded. We're talking $4-6 over spot for standard products. Some dealers are quoting 3 to 4 week delays. Others have quietly removed their buy buttons for certain products. And if you call them, actually pick up the phone and call, they'll tell you something interesting. We can sell you paper silver all day long, physical. That's a different story. So we have a contradiction. The paper price says abundance. The physical market says scarcity. One of these signals is lying, and the sophisticated money, the institutions, the central banks, the family offices that don't make trades based on CNBC headlines, they're betting everything on physical. Now let's talk about what happened on January 15th, because this is where the 72-hour clock started ticking. China didn't just wake up and decide to restrict antimony exports for fun. Antimony is critical for defense manufacturing, for solar panels, for batteries. But more importantly, it's refined in the same facilities, shipped through the same ports, processed by the same companies that handle silver concentrate. When China restricts one metal in the supply chain, they create bottlenecks for everything else. It's not a direct silver export ban. They're too smart for that. It's a systematic choke point that makes physical delivery more expensive, more complicated, more time-consuming. And here's what Wall Street doesn't understand. COMEX contracts don't care about complications. They have delivery deadlines, legal obligations, force majeure clauses that nobody wants to trigger, because the moment you do, you're admitting the system is broken. 72 hours after those restrictions hit, we started seeing the first delivery delays. Not from China, from London, from Switzerland, from refineries that suddenly couldn't source the concentrate they needed because the entire supply chain got reshuffled overnight. Here's what makes this different from every other silver shortage story you've heard. COMEX inventory, the actual physical metal sitting in registered vaults that can be delivered against contracts, is at levels we haven't seen since 2015. We're talking about roughly 70 million ounces in registered inventory. That sounds like a lot until you realize that open interest, the number of contracts that could theoretically demand delivery, represents over 900 million ounces. Now, most of those contracts will roll forward. Most traders don't want physical delivery, they want price exposure. But here's the game theory problem. If even 10% of contract holders decide they want physical metal instead of rolling their positions, COMEX doesn't have it. They'd need to source it from the market at current prices during a supply chain disruption, with China playing games with export logistics. The system works perfectly as long as everyone agrees to play with paper. The moment someone says, "I want the actual metal," the whole structure gets stress tested. And right now, with premiums spiking and delivery delays spreading, more people are asking for physical than the system was designed to handle. Now let me show you something that's happening while everyone's focused on the price drop. Central banks bought more gold and silver in 2024 than any year since 1967. Not just any central banks, we're talking China, Russia, India, Turkey, Poland, Hungary, countries that are actively trying to reduce dollar dependence. And here's what's interesting. They're not buying paper contracts. They're not buying ETFs. They're demanding physical delivery, and they're willing to pay premiums that would make a retail investor's head spin. The People's Bank of China added over 300 tons of gold to their reserves in the last 18 months. That's publicly reported. The actual number, if you include off-balance sheet purchases and unreported acquisitions, is probably double that. But it's not just gold. Silver purchases by governments and sovereign wealth funds have quietly accelerated. You won't see this in headlines because silver buying doesn't get reported the same way gold does. It's classified under industrial metals, strategic reserves, defense stockpiles. But if you track import-export data, if you follow refinery shipments, if you pay attention to the physical flows instead of the paper prices, you see a pattern. Institutions are accumulating while retail is panicking. They're using the COMEX price crash as a gift, a chance to acquire physical metal at discounts that won't last. And they're doing it quietly, because the last thing they want is competition from retail buyers who suddenly wake up and realize what's happening. Let me give you a specific example. In December 2024, a major bullion bank, one of the authorized participants in the silver market, got caught short on a delivery obligation. They needed 5 million ounces of physical silver to fulfill contracts. The COMEX price was sitting around $31 at the time. Plenty of liquidity in the paper market. But when they actually went to source physical metal, they had to pay $34.50 per ounce, a $3.50 premium, just to get the metal delivered on time. That spread, that difference between paper and physical, that's the real signal. That's what tells you the system is under stress even when the official price says everything's fine. And here's why the 72-hour timeline matters. When China implemented those export restrictions on January 15th, they triggered a cascade of contractual obligations across the entire supply chain. Refineries that had forward contracts to deliver silver concentrate suddenly couldn't fulfill them. Those refineries have contracts with mints, with industrial users, with bullion dealers. Those dealers have contracts with institutions and retail customers. When one link in the chain breaks, the delays ripple forward, and every delay creates another decision point. Do you wait for physical delivery at the contract price, or do you go to the spot market and pay whatever premium is necessary to get metal now? The institutions, the smart money, they've already made that decision. They're paying premiums. They're securing supply. They're not waiting for COMEX to fix its inventory problem. So let's talk about what happens next, because this is where it gets interesting. The mainstream narrative, the one you'll hear from financial advisors and talking heads on CNBC, is that silver crashed because industrial demand is weakening, because the economy is slowing down, because traders are rotating out of commodities. That's the surface story. But let me show you what's actually happening beneath that narrative. Industrial demand for silver in 2024 hit record levels. Solar panel production alone consumed over 200 million ounces. Electric vehicles, 5G infrastructure, defense electronics, medical devices, all of these sectors are using more silver than ever. So if demand is at record highs, why did the price crash? Here's the answer they don't want you to understand. The crash wasn't about supply and demand fundamentals. It was about paper market manipulation, about large institutional players using futures contracts to create the illusion of abundance while they quietly accumulate physical metal. You can see this in the COT reports, the commitment of traders' data that shows who's positioned on each side of the market. In the weeks leading up to the crash, commercial traders, the big banks and bullion dealers, massively increased their short positions in silver futures. They created selling pressure in the paper market, drove the price down, and then, here's the key part, they started covering those shorts by buying physical metal at discounted prices. It's a classic playbook: smash the paper price, scare retail into selling, accumulate physical on the cheap, then let the market recover once you've secured supply. And it's working perfectly because most investors don't understand the difference between paper silver and physical silver. They see the COMEX price drop and they think silver is bearish. They don't realize that while COMEX inventory is draining, while premiums are spiking, while delivery delays are spreading, the physical market is telling a completely different story. The smart money isn't watching the ticker price. They're watching registered inventory levels at COMEX. They're tracking refinery output. They're monitoring import-export flows from major producers like Mexico and Peru. And all of those signals are screaming shortage, not abundance. Now here's where the 72-hour crisis comes into focus. In exactly 3 days from when China implemented those export restrictions, COMEX faces its largest delivery month in over 2 years. February is historically a big delivery month for silver, and this February, open interest is unusually high. That means more contract holders than normal might stand for delivery, might actually demand physical metal instead of rolling their positions forward. COMEX has about 70 million ounces in registered inventory. Sounds like a lot until you realize that a single large institution demanding delivery of just 15-20 million ounces could drain a quarter of available supply. And if multiple institutions decide to take delivery simultaneously, if sovereign wealth funds or central banks decide they want physical metal right now, COMEX could face a situation where they literally cannot fulfill delivery obligations without sourcing metal from the open market at premium prices. That's the nightmare scenario for the bullion banks. That's why they're so desperate to keep the paper price low, to discourage delivery demands, to maintain the illusion that everything's fine. But the physical market doesn't care about illusions. The physical market runs on actual metal in actual vaults, and right now, those vaults are emptier than they've been in a decade. This isn't speculation. This is data you can verify yourself by checking COMEX inventory reports, by calling bullion dealers and asking about delivery times, by comparing spot prices to physical premiums. The disconnect is real, and it's widening. Here's what you need to understand about the end game. This isn't just about silver prices going up or down. This is about the fundamental structure of how precious metals are priced and traded. For decades, the COMEX system has worked because most participants agreed to settle in cash, to trade paper contracts without ever demanding physical delivery. That system allowed banks to create far more paper claims on silver than actual physical metal exists. It's fractional reserve banking applied to commodities. As long as everyone plays along, as long as traders are happy with cash settlements and ETF shares, the system holds together. But the moment confidence breaks, the moment enough participants demand physical delivery instead of paper promises, the entire structure collapses. And we're seeing the early signs of that confidence breaking right now. It's not a sudden crash, it's a slow erosion. A bullion dealer here can't fulfill an order. A refinery there delays a shipment. A mint runs out of blanks. Each incident is small, explainable, easy to dismiss. But together, they form a pattern. They tell you that the physical supply chain is under stress in ways the paper price doesn't reflect. The institutions know this. That's why they're accumulating. That's why central banks are buying at premiums. They understand that when this system finally breaks, when COMEX can't fulfill delivery obligations and has to admit that registered inventory is insufficient, the repricing won't be gradual. It'll be violent. Think about what happens in that scenario. If COMEX defaults on delivery, Even on a single large contract, the entire precious metals market loses faith in paper pricing. Traders who were happy to hold futures contracts suddenly want physical metal. Industrial users who relied on COMEX pricing suddenly can't source supply. Mints, refineries, dealers, all scrambling for physical silver in a market where spot supply has already been absorbed by institutions who saw this coming. The premium between paper and physical, which is already $4 to $6 per ounce, could explode to $10, $15, $20. At that point, the COMEX price becomes meaningless. The real price, the price you actually pay to get metal in your hands, detaches completely from the futures market. Now, I'm not saying this happens tomorrow. I'm not saying you should panic buy silver based on fear. What I'm saying is that the data is telling you a story that contradicts the mainstream narrative, and you have to decide which signal you trust. Do you trust the paper price that says silver is bearish while industrial demand hits records and inventory drains? Or do you trust the physical market where premiums are exploding and delivery delays are spreading? The institutions have already made their choice. They're voting with their capital, and they're voting for physical metal regardless of what the COMEX ticker says. The 72-hour clock I mentioned at the start, that's not a literal countdown to collapse. It's a marker, a point in time when stress in the system becomes measurable, when delivery demands meet constrained supply and we get to see whether COMEX can actually fulfill its obligations. If they can, if inventory levels hold and deliveries go smoothly, then maybe the system survives another cycle. But if they can't, if we see delivery failures or force majeure declarations or emergency rule changes that let banks settle in cash instead of metal, then you'll know the game is over. You'll know that the paper market has lost its ability to price physical metal. And at that point, the repricing won't be about technicals or charts or moving averages. It'll be about supply, demand, and who holds the actual metal when the music stops. That's the story they're not telling you. And that's why the next 72 hours matter more than most people realize. If this analysis helped you see what's really happening in the silver market, make sure you're subscribed to Currency Hacks, because we're tracking this situation daily and you don't want to miss what comes next.